I believe that, okay, not Brunswick, Inca, Nancy. Okay, I can see all of you. Okay, good to see you. You know how we do it. So please inform your family members, talk to them, invite them. We are much more than this. So let's invite people. Tell them to join on YouTube. We're streaming at the moment. Staff Shade, good to see you as well. Okay, so I mean, we just watched a video on Mansa Musa. And only every time I study Mansa Musa and they say he's the richest man that ever lived, I am always asking, why is Mali not a first world country? How come we don't have high rise skyscrapers? How come we don't have a research institute in Mali? How come Mali is now defined by some insurgencies and terrorism? How come Mali is not, a first world country? So consistently, we've seen Africans who are wealthy, but do they retain wealth? Do they sustain wealth? Right? How come they lose the wealth? And yet we've seen some other people, the Rockefellers, you've seen people retain wealth from family to family. And so how come an African was the richest man and Africa is what it is? So today we're going to be looking at, how you can build wealth. I mean, it's our speaker today is going to simplify it, and I want you to get your writing part ready because he's going to be sharing a whole lot, and then we'll ask him questions. We're going to take him. I mean, I have questions for him already. Well, our speaker today, I love his name. For a long time when I see the name, I struggle to pronounce it. I'm like, is this name Yoruba? Is he Egun? Is it what? But then he explained to me that it's the original Yoruba language, Sasaenia. Sasaenia means peculiar person, right? Sasaenia Paul Oluwabumi is a seasoned investment and development finance professional with over 15 years of experience managing complex multi-sectorial projects across both the public and private sectors worldwide. Currently, Paul serves as a senior vice president and enterprise product manager at Citigroup based in Dallas, Texas, where he leads strategic initiatives aimed at driving innovation and growth across Citigroup's diverse global portfolio. Before joining Citigroup, Paul spent 8 years as a diplomat at the OPEC fund in Vietnam, Australia. There, he spearheaded numerous multi-million dollar project finance spanning 14 countries in Africa, Asia, and Europe. His leadership in his role involved direct engagement with high-level government officials and C-suite executives, as well as partnership with prominent global organizations such as the United Nations, European Union, World Bank, International Finance Corporation, and USAID. Paul's academic background is equally impressive. He holds engineering degrees from Nigeria and the United Kingdom, a finance degree from Germany, and an executive MBA from the prestigious Kellogg School of Management at Northwestern University. He's also a certified project manager professional and a British chartered engineer. Beyond his professional endeavor, Paul is passionate about music, performing with local bands, volunteering with NGOs, and cherishing quality time with his family. With a proven track record of leadership and collaboration at the highest level, Shashaini Paul Oluwabumi is dedicated to driving impact, change, and fostering sustainable developmental goals across the globe. Okay, so let's make welcome my brother Shashaini Paul Oluwabumi. Paul, you're welcome. It's so good to have you here.
Yes, thank you all very much. Thank you. I'm very, very grateful to be here, and thank you for giving me a platform. I'll start by saying thank you to Praise Forway, because even if you have a gift, you still need a platform that someone is going to give you your creative self to share that particular gift. And I don't take this for granted at all. I know a lot of us are Africans, and if you're at a party, and no matter how rich you are, you need people to come and spray money on you. So that's honor. So you can't really honor yourself. You need people to honor you and give you a platform. So thank you very much, Praise Forway, for the invitation. Thank you, House of Saviors. It's amazing to see people from all over the world, from Zambia, from Sweden, from the UK, from the US, and I know that by God's grace, today is going to be an amazing session for you all. So I'll start sharing my screen, and I hope that this session will also be interactive as well. And the first thing I will do will be to start by reading a part in the scripture that really speaks to me a whole lot about wealth and finance. So in the Bible, in the book of First Thessalonians, chapter 4, verse 11 to 12, it says that we should make it our ambition, to lead a quiet life, and that you should mind your own business, which a lot of us need to do more of, and also work with your own hands. And that's where I want us to focus on work with your own hands. And then verse 12 goes on to say that so that your daily life may, number one, win the respects of outsiders, like Van Samuel that we saw, and that you will not be dependent on anybody. So God's vision for us is to be independent as aware and also to add value to others. And I will start by telling us a story. Uh, telling us a story about how your mindset in terms of wealth affects your outlook to a whole lot of things. I remember when I was still in my early 20s, I had the opportunity to buy my first apartment in Europe. I think I was like 23, 24. And because of the kind of job that I had the opportunity to buy it at 0% equity. So that means for those who live, outside Nigeria and all that, that means you can buy property without putting any down payment. And I was scared because I said, oh, I don't have a mortgage of like 20, 25 years, and I almost said no to the opportunity. But then God brought people into my life who encouraged me, who mentored me, who explained, the whole process to me. And looking back now, I'm glad that I took the step because that opened, the door of wealth, to me. And the reason why I'm sharing that opportunity and that story rather today is even if you're on the call and you feel confused about how to go about your personal finances, you're confused about terms that people throw around and all that. I want you to know that I was at that place before, and there is absolutely nothing that you cannot learn. So the mindset is super, super important. And that's why the Bible says also that renewing your mind. So that's the first thing that I want us to understand today, that in terms of wealth, apart from the work that you have to do, also the mindset about wealth is super important. Now, a couple of disclaimers because I'm based in the US. Number one is I'm not giving any investment tax legal advice or accounting advice. So the way you manage your money is your prerogative. I'm only sharing examples that have worked for me, that have worked globally. And yeah, it's your prerogative as well. Now, number two is do your research very carefully before investing. So I see a lot of people that I talk to globally and all over the world, they just listen to what somebody says without doing their own due diligence, and then they jump and invest. So always do your own research, very carefully before investing. And also number three, which I really love, is if you're going to be investing in the stock market, because I was talking a lot about the capital markets and all that, make sure that at least for the short term, you shouldn't invest, what you need in the short term in the stock market. And I'll give you an example. Let's say you have, five children and all of them are going to school next week. And you have 100,000 naira, 100,000 pounds, and you know it's due next week. Please don't invest the money in the stock market, pay your children's school fees because the markets in general can be very, very, very rational. And also, number four is past performance. It's not an indicator of, future performance. And so what that means is investments on the markets in general, it's always very dynamic. So you'll see some numbers on the screen that I'll share with you that, oh, this particular index, the Nigerian All Share Index, for instance, did that 7% last year. It doesn't mean that it will do that 7% next year. You can only project, you can only hope, and that's why risk management is super important. And then finally, the other disclaimer is the market can stay irrational for longer than it can stay solvent. I'll say that again. The market can stay more irrational for longer than it can stay solvent. And I'll give you an example. So I remembered by God's grace when I moved to Dallas, a couple of years back, and I wanted to buy a property in Dallas, and the interest rates in the US were in the range of 7%, 7.5%, 8%, but I really needed to buy a property. And all my friends, a lot of my friends advised me that, hey, wait, because coming from Europe, where interest rates, at least in mainland Europe, are like 2%, and then you come to the US, where it's like 8%. So everybody said I should wait for the market to settle. But I've done my numbers, I've done my calculations, and knew it was the right time to buy. Now, that was 3, 4 years ago. right now, interest rates in the market are still in the range of maybe 6 point something percent, so it is falling, but not falling as high. So the market can stay as irrational as more irrational than you can stay solvent. So keep that at the back of your mind because, again, the Bible says that wisdom is profitable, to direct as well. So just wanted to share those things with you. And now, moving forward, so what I intend to do is to set a stage. And before we even talk about investing at all, I think there are pillars of personal finance that we should all know. And I'm sharing from the perspective of someone that was born in Africa, grew up in Africa, Nigeria to be specific. By God's grace, I've lived and worked in Europe. I want to say Europe, I'm talking about the UK, London, and also went to school in Germany and also lived in Vienna, Austria. So I understand the way the African system works. I understand the way the British system works in finance. I understand the way the European system works. And now I live in the United States. So I also understand the way the American system works. So I'm talking from the perspective of someone that has lived and worked in all and invested in all those different continents. And I can tell you that globally, there are pillars of personal finance that we should all know. And the first thing is, before talking about investing at all, will be budgeting, tracking your personal expenses, which I will go into. It will be making sure that you pay down your debts as fast as possible. And then I'll talk about planning for retirement. And before we now talk about investing. So I want to lay the framework before you even start thinking about investing and being as rich as Mansa Musa that you saw. I think there are a couple of things in terms of personal finance about putting our house in order. So just wanted to set a stage. Now, the first one's personal budgets, and what I always advise people to do is to have an idea of where your money is going. Yeah, so it's very important for you to understand where your money is going to, because we spend so much time, in our offices or running a business that it would be a shame for you not to know where exactly your money is going to. And there are rules of thumb that again advise globally. And the first is out of your net income, it makes sense for you that 50%, ideally, 50% of your monthly net income should go into essentials like your rent, or your mortgage, or feeding or transport. Now, I say ideally because I understand that there are situations in life where, especially in a case where there are high interest rates, or you got a job you move from the mainland in Nigeria to a place in Lekki and you're an intern or you're not earning a whole lot, and close to 90% of your money goes to rent. So that should be a situation in the short term. But ideally, your target should be that your income should either grow larger or your expenses should either reduce. Well, the target is for 50% of your monthly net income to go into like your rent, mortgage, food, transport. That's the target. Now, 30% of your income can now go into things like your lifestyle, making sure that you're comfortable and all that. And of course, your 20% should go into debt pay down and a retirement savings. Now, for those of us on the call that are Christians, we have to pay our tithes. That's again a separate discussion which I would get into. But every other thing that you need to do for religious reasons, you can take it from all these buckets. And what I always advise people to do is to track, your monthly expenses in a detailed way, as detailed as possible. So if you know that you're earning 500,000 naira or $5,000, you want to be sure that at least from between January and April, you track where your money is going to, you track where it is coming from. So with that, when you do that, you set a framework. Now, this personal budgeting is super important because with this, you have a rough idea of how much you can save, how much you can invest every month. And you also have an idea of when to say no to request because obviously a lot of us are African heritage. We do know that black tax is real. We have to support our family members and all that, but sometimes we do it so much that at the end you don't have anything to save or invest. So budgeting helps you because money you don't have, money you've not assigned to something, that's what you can easily spend. But if you've already tagged it to something, you really can't, give it away. You have a bucket that this month I can't give more than $1,000 or $500 or 500 naira away because that's what I can afford. So when people come to you with different kind of requests, you can say no. So budgeting, that's the first thing I always encourage people to do. Now, after budgeting, the next step on your personal finance journey is to create a rainy day an emergency fund. And this is super important. And I'll tell you a story. So by God's grace, I had opportunity. I was given a scholarship to study in the United Kingdom. After my first degree in Nigeria, I got a scholarship from ExxonMobil, to study in the United Kingdom. And wow, when I got a Mobil scholarship, everybody thought I became rich, you know. And the scholarship is one of the most generous in the world. Pays for your tuition in the United Kingdom, pays for your rent, and gives you like a stipend of close to £1,000, £750 every month. And I'm talking about close to 15, 20 years ago. That's a lot of money. But now the problem is before Mobile starts sending you money, they need to set you up in their system back in Nigeria. And that unfortunately takes time. So you can imagine I got to the UK in September, and between September and December, there was no money for my scholarship, and I was broke. But what happened was, and that's why rainy day fund is super important. Before I left Nigeria after my NYC, I was privileged to get a role at Nestle, the graduate training program in Nestle then, and I was paid really well. I think again, Nigeria then again many years ago, you can imagine being paid like 400, 500,000 euro thereabouts. So I was paid that amount, and I was saving. I was saving. So I had like enough to live on. So in the UK, when I got to the UK and there was no money from my sponsors, what I did was I used my Nigerian ATM card and I was using it to withdraw all the money that I had saved just for working at a particular company for like 3 months. And that's what kept me in the UK. Because for those who live in Europe or even outside Nigeria, you know that when you're new in a country, everybody's scared because they don't know your position. They don't know if you have your papers. So nobody wants to move close to you. So there was no support at all. But without a rainy day fund for 3 months, I don't know how I would have survived. Now, I explained the story to just let you understand that if you're working or if you have a business, it is imperative for you to have a bank of money somewhere that you can call on. Now, last year when I did this training, for the first time, I was here in the US, I told them that the rule of thumb is to keep between 6 to 9 months of your salary in living expenses in cash or immediately accessible. Now, I don't really encourage having a lot of money in cash. So when I say that something that is immediately accessible, it can be, keeping your money in the capital in a money market. Anything that can make you liquidate your investments within 1 or 2 days. We also call it cash, technically, in finance. Now, because of macroeconomic conditions in the world globally, with what we have seen in the banking and the finance world is if, God forbid, someone loses their job or the business is not doing well, it takes almost 1 year to get an average of 1 year to get something else. I mean, before the average was 6 to 9 months, now it's 9 to 12 months or thereabouts. So if you're working, even before thinking about investing at all, it makes sense for you to, keep close to 9 to 12 months of your, living expenses in an emergency fund. It's super important. So keep that in mind after budgeting. You want to make sure that you have a sizable amount in a rainy day fund so you can call on it if you need it. The Bible says if anyone wants to build a tower, as well, you have to sit down and count the cost. And part of counting the cost is making sure you have a contingency plan. So that's why this is super important. So we've talked about budgeting. We've talked about having a rainy day fund. Now, the next thing that I want to talk about is paying off consumer debt. And this is super important. Now, for those living outside Africa, we there's a lot of things rolling on your credit card as aware. But let's even leave the credit card, debts for now, and let's talk about like debts from I know in Nigeria now and in other places in Africa, we have a lot of buy now, pay later, opportunities where if you don't have the money for purchase, you can always, go to a bank or go to all those fintech companies and get a payment, and then you can pay it off as time goes on. But anyway, what we've seen in the investment banking space is the rates of debt is increasing, astronomically. And because of that, we encourage people to be very careful in terms of your debt exposure. And if you're on the call and maybe you're indebted in any way and you're worried and all that, I want you to, just take a step back and breathe, and just understand that you know the plan. Now, there are two methods that we use, or two methods that we advise people, to use, at least if you're into a lot of debts. So the first is called the debt avalanche method, and the second is called the debt snowball method. And this analogy is from those that ski or from if you're on top of a mountain. When you say there's an avalanche is a huge, sheet of snow that starts from the top of a mountain very big, and as it cascades down the mountain, it breaks into very small pieces, and at the bottom, there's no piece at all. So what that means, applying that analogy, to paying off your debt is you want to prioritize any debt that has very high interest rates. So again, credit card debt is like 27% or thereabouts. You want to pay that off first, or if you have a buy now, pay later scheme, it's 10%, you want to pay that off first. So what that does for you is you're going to pay off any debt that has the highest interest rates, and as time goes on, the interest rates that you pay will keep on reducing. So you pay less interest rate over time. Now, the other method is the debt snowball method. So what that means, again, using the analogy of a mountain, when you have a snowball, it starts very tiny, very small. And as it cascades down the mountain, it grows bigger and bigger and bigger and bigger. So that analogy, what it means is you're prioritizing balances. So if you owe $100,000 or 100,000 naira, you owe 500,000 naira, you want to pay off the one that has 100,000 naira balance first, and then you move down. Now, I've said all this in theory, and in theory, yes, it makes sense. But then in practical, I'm sure some of you will have a question that how can I pay off debts when I don't even have money for my own living expenses? And I'm not far removed from the economic reality of the way the world is now. And what I always tell people is if you want to pay off debt, but you don't have even enough income to cover your basic needs, then there are two things that you can do. That will be increase your income, find a way, prayerfully by God's grace to increase your income or reduce your expenses. The reducing expenses part, I know it may not be easy, especially when you have a family, you have kids and all those things. And if it's not possible, but the increasing income part maybe something to also look at, which will be either getting another job, uh, getting additional sides of income, you know. And I'll pause here and just explain something. So there's this verse in the Bible. So in the book of Genesis, chapter 2, verse 10, that says that talking about the Garden of Eden and saying that there was a river that's watering the garden that flowed out of Eden, and that from there it was separated into four different headwaters. And what I've seen a lot of theologians, a lot of Bible scholars do is that you should have at least minimum, four streams of income. And I didn't believe this for a long time. And there was a point in my life when I started having a family, and I saw, quite frankly, I was in a lot of debt you know. And I sat down, I was praying today, and I was just thinking that what else can I do apart from my regular job? And then it occurred to me that, oh, I've lived in all these different countries globally. By God's grace, I've traveled to like over 45 countries of the world. So I can interpret different cultural, instances to different people. And the thought process was, why not start a consulting company? So I started a consulting company, started advising, businesses, and honestly, I was shocked at how much money I could make on the side. So for someone on my call in the same situation where you feel like you need to increase your income, you need to dig deep and look at what you are good at. And I know it's very easy to say, but you have to take the first step of faith. So apart from the regular job, think of all the sources of income, and your target is to have at least a minimum of four streams of income. Once you have that, paying off debt will not be a problem. Now, if income is a challenge, then you might want to look at your expenses. If you have two cars and you don't need two cars, then you might want to scale down and make sure that you have one. If at this particular phase of your life you can go out to eat all the time with your friends, it's okay to say no. But whatever you do, make sure that a consumer that you find a way to pay it off. Quickly moving on. So we've talked about budgeting. We've talked about having a rainy day fund, making sure that your debt, rates is as low as possible. And then we'll talk about retirement savings. Now, when you're young, we don't really think about retirements because you feel like you have a lot of time. I remember clearly when I was 3 years old, you know, and time goes by as fast as possible. So I know there are different kind of pension funds that we have in Nigeria, in other parts of Africa, in Zambia and South Africa, in Europe, at least in the UK. We know that you contribute to the national insurance schemes. There are different kind of pension funds. If you work for a private company or private organization, there are different kind of pension funds that are set up for you. In the US, you have your 401k and all that. It's super important before thinking about also investing long term to make sure that you have a plan for retirement, no matter how young you are, from your first paycheck. You should start thinking. And there are a couple of questions that you need to answer. So you can see the questions on the screen. How much money do you need to retire comfortably? How long are you going to believe in God? As God has promised us long life. And what we've seen is because of technology and healthcare, people are living longer. So people are living up until 90, 100. So just estimate that you'll be alive for 100 by God's grace, up until 100. So you want to estimate that when you retire at 70, at 60, at 40, do you have enough income to cover your living expenses? Because what I've seen when people retire is there's a sudden drop in their income and in their living expenses. And because they've not planned adequately for it, it can lead to like depression and stuff. So you want to really take a step back and think about that. I know that these questions are very difficult to answer, but some important things that I shouldn't overlook is you have to look at, if you're married by God's grace, does your partner also have income that is coming in after retirement that both of you can plan for? Do you need to scale down? If you have a big house and you have 5 bedrooms and all the kids have gone to school, do you need a 5 bedroom house? Those are some things to think about. How much of a drop in your quality of life can you afford, to lose? So those are things to think about. So once you have this framework in mind in terms of your budget, in terms of having a rainy day fund, in terms of making sure you pay off debt and having a plan for retirement, then we can now move on, to the next stage, which is investing. And before we go on, I want anyone, uh, anyone listening to me, you can just pop it in the chat what you think about investment. So I'll take the slide away as a way, and I just want to see, the responses in the chat group. So what do you think about investments? What do you think investment means? Anybody can try, can just pop it in the chat. What do you think? We don't say that you want to invest. What do you think it means?
Mm.
Yeah, we can put this in the chat. What do you think it means when we say that, oh, we should invest? Investing to make more money. Yeah, thank you very much, Engineer Benson. Opportunity to grow your money. Yes, you're perfect. It means making productive efforts to multiply money. Yes, yes, that's perfect. All the responses, and I really do appreciate you taking time to respond. And all the responses are quite frankly make a whole lot of sense, as well. And going back to the screen that I have on investing. So if you look at the right-hand side of the screen, it talks about investing as deploying capital towards a project or activity that is expected to generate a positive financial return over time. I want you to take note of two words, a positive financial return over time. So if you are putting money in something and it is not giving you a positive return, you're not investing over time. So it's possible for you to lose money when you start a business, for instance. It's possible for you to lose money for a short period of time, but in the long run, whatever you're investing in should generate money. Yeah, so that's investing. And I'll take a step back and just explain a couple of things to set a stage so that from here we can move on, super fast. Now, when we're talking about investing in the finance world, there are two terms that we like using. One is called alpha, and the other is called beta. So alpha and beta, like A and B, those are Greek letters for A and B. So what alpha means is, and I want us to pay attention carefully. So what alpha means is when you're investing in something, there is a benchmark. So a benchmark is called the market. I'll go slowly because I really want you to get it. So a benchmark is called the market, and I'll give you an example. A lot of us have heard about the S&P 500. So that's an index that tracks the 500 largest companies in the US. So that's called the S&P 500. So it's used as a market benchmark for the United States. In Nigeria, I'm sure you've heard about the NGX All Share Index. So that's an index that tracks the performance of all the companies that are publicly listed in the Nigerian Stock Exchange. So that's used as a market benchmark for Nigeria. In the UK, I'm sure you've heard of the FTSE 100. So that's an index that tracks the 100, largest companies in the UK. So that's called the benchmark, the market. So when I say the market, based on where you are, I'm referring to these different benchmarks. So I wanted to explain that because I'll be using the term a whole lot, in the presentation. So the market's a benchmark. So when you say, what is the alpha of an investment? So that is when you invest in something, how much more can you make more than the market? So if the Nigerian All-Share Index is at 30% this year, and we're saying there's an alpha of 10%. So that means we're saying that it's making 10% more than the market. So when you want to invest in something and you hear alpha, you know what that means. Now there's something called beta. So beta is the level of correlation of your investment to the market. So if you remember when we had, COVID, and even earlier this year, in the US when there were tariffs, the market went down totally. Everybody was losing money. So the level of correlation. So if you invest in something and if the market is down, your investment is also down. That means that the beta of your investment is 1. So that means it correlates. Correlation means it moves in the direction of the market. So if you invest in real estate, for instance, and because the economy is not doing well, the market is down, your real estate investment is down. So the correlation is 1. But if you invest in something and when the market is down and your investment is up, we can talk about option strategy later. That means that the level of correlation is -1. So alpha is the level of return rated on the market. Beta is the level of correlation with the market. So just wanted to explain that. And I'll take a pause here. And if you look at the left-hand side of the screen, I was talking about if you want to invest in something, you have to look at the age that you start. I know we saw the video of Mansa Musa, and if you remember, the video, I'm not sure it showed in the video, but it started really early, became an emperor quite young, invested in gold, used economic prowess to grow money. So the younger you are, the higher the level of risk that you can take. So if you're here on this call and you're in your 20s or you're a teenager, congratulations to you because you're on the path to doing what a lot of us learned a bit later in life. So the younger you are, the higher the risk you can take in the stock markets. You can make risky investments. You can invest in startups and fintech opportunities and all that. Once you start hitting your late 40s and 50s, you have to be a little bit more careful about the kind of risk that you take. You don't want to take your pension money and invest it in something and it doesn't work out. So investment depends on your age. The earlier you start, the better. The older you are, you have to be more careful about the kind of risk you take. Now, the other thing is the level of risk of the kind of job that you take. And I'll use the United States as an example. So historically in the United States, if you have a government job, it is a safe job. I say historically because those things have changed now. So if you have a job that is super stable, they don't fire, they don't do anything, you're just there, or your uncle is the managing director, they can fire you. Congratulations, you can take a lot of risk. But if you're in a job that is, for instance, investment banking or finance, where you work in a bank, the money is good, but anything can happen at a time, you also have to be careful with the kind of risks that you take. So I wanted to set the stage so we can think a little bit more carefully. Now, I'll talk about a problem that I see with those of us of African heritage is, again, going back to the right-hand side of the screen, I said investment generates a positive financial return over time. But a lot of us are not patient, and that's a problem we have. If you look at, if you look at Bill Gates, you look at Jeff Bezos, you look at Warren Buffett, it took them years to get to where they are today. And let me talk about pyramid schemes. Let me talk about MMM. A lot of what happens is a lot of us, receive a call from a friend that, Shade, oh, Tunde, there is this investment I did. Oh, I invested $500 yesterday. And last week they gave me 1,000 naira. Then you go to church, you give a testimony, everybody claps for you, say God is good. That's a pyramid scheme. And I will explain to you how you can know what a pyramid scheme is and not. In finance, and I also want us to pay attention carefully. In finance, we have something called the rule of 70. Mathematically, it's the rule of 72, but to make it easy, you call it the rule of 70. Now, before going ahead, again, pop it in the chat and just guess how long does it take money to double? So if you invest in something, how long just do you think it takes money to double? It's a trick question because I didn't really give you all the variables that you need, but just hazard a guess. If you invest in something, you buy real estate in a particular place, how long do you think it will take for the value of the house to double? You invest in the stock market, how long? 20 to 30 years from Itoro Igwe, okay? That's a good guess. Anybody else? How long does it take money to double? You bought crypto, 60 days. Nice one. Okay, that's also very super good. 10 years from Jen Lina, okay? Anybody else wants to try? How long does it take money to double? 1 to 5 years. That's fair. That's fair. Okay. You, yeah, 10 years. Only Olatubosi. Thank you. Olanike, at least 10 years. 10 years. Okay, fine. Thank you very much. I'm even very impressed with the response I've gotten because there was a time I was again doing the session and asked that how long does it take money to double, and the person said, 10 days. You know, so for you to understand what a pyramid scheme is, we need to know how long it takes money to double. So would take 70. So, and remember these, and you won't make mistakes in investments, at least again. So you take 70, you divide it by the interest rate that investment is going to pay you. And the answer will give you how long it will take that money to double. So let's walk through a live example. Let's say a friend calls you that there's an investment, MMM investment, and you ask them that, okay, what are they investing in and what is the interest rate? And if the person tells you the interest rate is 10%, so that means it takes 70, you're divided by that interest rate, which is 10, 70 divided by 10 is 7. So that means if you invest in that particular whatever, it will take 7 years for that money to double. Obviously, we're not talking about compounding interest yet. So it takes money to double an average of 7 years, because generally the market does like 10 years. But again, if you invest in like high growth, sectors or tech, then maybe 20, 30%. So the reason why I'm saying this is I don't want us to fall into scams. Investment time in the market beats time in the market. So you have to understand that it's how early you start and doing it constantly. So the rule of 70, I don't want us to fall into, pyramid schemes. Just before I move on from this particular slide, I remember that time in Nigeria when there was MMM and all those pyramid schemes. I had a family member who she invested, so she was always on her phone, and she's in the choir, so she would always sing and start dancing, in the kitchen. And I asked her that, oh, is everything okay? You seem very happy these days. She said, I invested $50,000, and in 2 months I will get 1 million naira. I said, wow. I was waiting for the money because I also had things I wanted to buy, but the money never came. MMM crashed. you know. So be very careful. Don't fall into those pyramid schemes. Cool. Now, I have a question for you. And again, I want this to be as interactive as possible. So Warren Buffett, is on the screen here. And Warren Buffett is saying that rule number one when you're investing is you should never lose money. And rule number two, Warren Buffett is again saying, don't forget rule number one, so never lose money. I want you to put in the chat very quickly that what do you think about this statement? Does it make sense? Do you agree? Do you disagree? What do you think? So Warren Buffett is saying don't lose money, and is saying that you should never lose money. Does it make sense? So what do you think about this? Just put it in the chat. Is it a reasonable statement? Is it an unreasonable statement based on your thoughts? And I know Warren Buffett is very rich. It's just a case study, so don't be scared that because Warren Buffett said it, I have to agree. No, no, no. Feel free to disagree. So what do you think? Is this statement, does it make sense? Okay, again, so the responses come in. Okay, Anna Nicole is saying the compounding principle. Itorigwe is try as much as not to lose money by taking a calculated risk. Okay, I think about it as being careful. Perfect. That's from Okweloa Yemi Gurambi. I agree, but it's not complete. Makes sense. Okay. Talking about stuff, don't say one markets down. Wait, okay. Or will I be? This seems unrealistic to me unless you know the future. Good. All your responses are actually very correct. And I would say that so what Warren Buffett is saying here is that when you're investing, your mindset should be that you're going into this. Remember I talked about the mindset, never to lose money consistently. And that's why the person that said something is missing is correct. You shouldn't lose money consistently. So let's talk about Uber, for instance, or let's talk about Flutterwave. Where Flutterwave started. These are startups that started in Nigeria and they needed investors to back them off. So that means the startups were making revenue, but they were not profitable. So that means the expenses, the salaries, the technology were greater than the amount of money they were making. But they had investors that believed in them. And now looking at Flutterwave or Dell after many years, you can see that they're unicorns, like what over $1 billion. So you can lose money in the short term, but you shouldn't plan to lose money in the long term. So that's the first thing. Now, the second thing about the slide is talking about realized gains and unrealized gains, realized losses and unrealized losses. And I would explain that very quickly. So when you invest in something and the market goes down, you've not lost until you sell. You know what I mean? So let's say you buy a piece of real estate and you bought it in a place because Dangote is building a refinery, prices are very high in that particular area. You bought land there for 2 million naira, and then people are telling you that I mean, anyway, the interesting thing is normally in other countries where I've lived, people don't want to buy land close to refinery, at least residential, because of pollution and all that. But for something commercial, yes. But anyway, that's the discussion for something else. And then people come later to you and say that, oh, there's pollution in this area, then the value of the land goes down to, from 200 million to 50 million. You've not lost if you don't sell. Now, there are cases where you have to get out as fast as possible because the markets will keep on going down. But if you have reason to believe that there is another investment that's coming or there's a commercial real estate that needs that, then you can hold on to it. So there is a difference between realized gains and unrealized gains. Or realized losses and unrealized losses. So if the market is down and you hold on to it, you've not lost anything. You can wait until the market goes back up, except if you have reason to believe that the market will always be down. So just wanted to explain that, to you. And also remember, time in the markets, it's quite difficult. So that's why I don't, teach options. Quickly moving on. I want us to spend some time on this. And it might seem very silly to you initially, but I'm sure that once we've looked at, this particular slide for 1 minute, it will make sense. And I'll use this to explain, the factors that are really driving the market, as it were. So look at this slide, and the way to read it is from left to right. And I want someone to just put in the chat what you think this slide is saying, this particular comic representation is saying. So look at it from left to right and put it in the chat. What do you think this means? And I'll give you a bonus. This is an analogy or an anagram of the way markets function. When I say markets, I mean the capital market, the real estate market, the crypto market, the stock market, the equities market. So look at it from left to right, and there is no answer that's wrong. And let me know. Communication has been distorted to look where, yep. The money voices we hear from brokers, yep, that's also very correct. That's from Okwelua. Anyone else wants to hazard a guess? The market is an echo of itself. I really like that. That's from Tade. Market psychologists is to drive the herd. Okay, makes sense. Yep. Marketing operation patterns, inadequate information. Now impressed. I mean, Chris Forway, I'm really impressed by the House of Saviors. These are some of the best responses I've gotten so far, and I've done this again globally, and I would just explain. So if you look at the left-hand side of this comic, there's just a gentleman talking about, hey, I've got a stock here that could really excel. Now, the person wasn't paying attention and said Excel. Excel rhymes with sell. And somebody got that information and started shouting, sell, 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 sell. And the markets went crazy. Now, if you're selling something all at once, that means that a demand has come down, then prices will come down. That's a very good time to buy, by the way. That's what a hedge fund will do. And then if you look at here, there's a gentleman that's saying, I can't take this madness anymore. Goodbye. Another person here that said, oh, buy Rams will buy. They say buy, buy, buy. Whenever there's buying something, the price goes up. because demand is high. And that's why you will see that the market is sinusoidal. So sinusoidal means, in mathematics means, it goes up, it comes down, goes up, it comes down, goes up, it comes down. So three things that I want you to remember that drive the market for anything at all, that you're in business, you invest in the stock market. So three things that drive the markets, three things that drive the value of assets in the market. Three main things. Uh, Number one is shareholder investor sentiment. Investor sentiment. Number two is expected earnings. And I'll put expected in the bracket so it can be earnings or expected earnings. And number three is interest rates. I'll say that again. There are many things that drive the market, by the way, but these three have been psychologically proven to be the three most important things that drive the market. So interest rates, earnings, in bracket expected earnings, and then investor sentiment. So just quickly going through all those three. Investor sentiment is, let's talk about Uber. We all use Uber. We use Uber in Nigeria and all that. Uber had been in operation for close to 6, 7 years and was never profitable until last year or 2 years, if I remember correctly. But the value of the stock of Uber was super, super high. And why? Because people believed in Uber as a product. And let me take a segue, from this into personal life and professional life, because I'm very passionate about this. When Jesus was talking to his disciples, he asked his disciples that, who do people say I am? And I've met with a lot of people that will say, what people think about it doesn't matter, blah, blah, blah. To an extent, you're correct, but also to an extent, you're wrong. Because your perception is your reality. So even if you are the smartest person in the room, but people believe that you're dumb, then that means you're dumb. And at least for those of us that work, outside the country, you've met a lot of people in your organization, especially those that don't necessarily look like us, that have the confidence because they've always been told they are the greatest, but they don't really know jack. But they believe they are the greatest, and they know how to talk the talk, and the perception is that this person is greatest. And you went to all these great schools, you have all these great degrees, but you're not confident. So perception is reality. And taking that back to investment, if people believe that this particular investment is more valuable than it is to drive the market, it can lead to a bubble. That's a risk. But just talking about it from a fundamental level, what drives the market and the value of assets? Number one, perception. So even if you have a great product you're selling, but if people believe the product doesn't make sense, it doesn't make sense. Why do people buy Apple products right now? Because the perception that Apple signifies class. Apple and Samsung, theoretically, if you break it down into components wise, they're the same. It's just the brand and they're manufactured from the same factory in China. Just the brand and it's different. So what drives valuation of assets? Investor perception. What drives your value as a person is people investing in you, their sentiment about you. So always manage your perception. That's just advice by the side. Number two, interest rate. So mathematically, when you're calculating the value of an asset, we do something called a discounted cash flow model in finance. So what that means is you take either the revenue or the income, you divide it by the interest rate. So the higher the interest rates, the lower the valuation, and then the lower the interest rates, the higher the valuation. So that means that if interest rates will keep on falling, at least in the US, you will see that the value of stocks will keep on getting higher. Then it can also lead to a bubble because we are overvalued, but I'll save that discussion for another day. The third thing that drives the market, the valuation of assets, is earnings. So if you're making money, people believe that, oh, this asset or this value has the potential to grow further, or expected earnings. And I'll give an example. So we have something called earnings reports. So those are reports that the companies release every month, every quarter, depending on wherever in the world you are. And Meta, for instance, I'll give you two examples, Meta and Nvidia. So Meta released the reports, it crushed its earnings targets, but then investors saw that the amount of money that Meta was spending on data centers and artificial intelligence was too much. So although Meta crushed its targets, the stock price of Meta still went down because investors expected more earnings to make up for that capital expenditure, that it had. Nvidia, for instance. So 2 weeks ago, when Nvidia released earnings, the stock price of Nvidia went crazy, and Nvidia reached a valuation of $5 trillion. It has never happened in the world before. Now, what happened? NVIDIA showed it had like $250 billion of revenue in the pipeline. So that's not earnings that has materialized, that's expected earnings. And investor said, oh, wow, that means for the next 3, 4 years, because of artificial intelligence, NVIDIA will keep on growing. So remember, earnings, in bracket expected earnings, interest rates, and investor sentiment or shareholder perception. So very quickly, because of time, I see that I probably have like 20 minutes more before we get into questions. So I'll talk about some major investment vehicles. And because we're such a global and multicultural audience, I'm not going to talk at all about real estate and businesses. We can talk about it some other time, but I'll talk more about investment vehicles that you have globally in different countries. And so stocks, bonds, funds, real estate, crypto, but I'll focus more on stocks and equities and also on funds. That's number one, number three because of time. Now, uh, so talking about stocks, and I would assume that a lot of us know what stocks are. So basically, stock is a share of, a company, a public or private company. That's what it means, and the way it works. So four things I want you to keep in mind about stocks. Four things, and they're really two things, but they're interrelated. Value, value stock, and then growth stock. I'll say that again. Number one, value stock. Number two, a growth stock. And then number three is capital gains. And number four is dividends. And I will explain why they're all interrelated. So when you say something is a value stock, so that means that let's take Coca-Cola, for instance. Coca-Cola won't really be in the news because it's growing fast and all those things. It doesn't use artificial intelligence. But Coca-Cola has been here for over 100 years. It will be here, if God says so, for the next 100 years. So there are stocks of companies that, by virtue of the service that they offer, even if they don't grow exponentially, they will always be there. And those stocks are called value stocks. And most of those stocks pay what? They pay dividend. So that's the first thing, value stock. So value is tied to dividend. Now, we now have another group called growth stock. So a growth stock is like Nvidia, for instance. Nobody really knew Nvidia like 10, 15 years ago, but all of a sudden everything is going up. Tesla, for instance. So nobody really knew, Tesla as were 20 years ago, but all of a sudden it's going up to an extent. So growth stocks are tied to capital gains. So capital gains is when you buy something, $500, and then the value of that asset is now $10,000, so that's capital gain. So growth stocks are tied to capital gains, value stocks are tied to dividend. So when you're investing, or if you're thinking about investing in the market, it's very good to have a diverse portfolio and a healthy mix of growth and value stocks. So it's a healthy mix of the Coca-Colas of this world or the Nestle's of this world or wherever you are, and then growth stocks that go as fast as possible. Now, obviously, you might want to be more biased towards the growth, stocks, but don't make 100% of your portfolio, the growth stocks. So just wanted to explain that, quickly. And then you have bonds, which I think a lot of us might know about. So a bond is when the government, and interestingly, not just the government, companies can issue bonds, local governments can issue bonds, municipalities can issue bonds. But we always think of bonds as the government because they are the major issuer of bonds. But again, a bond is when a government wants to borrow money from the people, and then because they want to borrow money from the people, so you give the government, let's say, you buy, I think now in Nigeria, let me use Nigeria as an example. So you can invest in bonds in Nigeria with 500,000 naira, for instance, or I think the minimum is 1 million. I'm not certain of the number. So you give the government 1 million naira, and then what the government does is they'll tell you that the tenor, the lifetime of the bond is 12 months or 24 months. So every month, the government will pay something called a coupon. So that's an interest payment. And at the end of that life cycle, you get your principal back. So that's basically what a bond is. Quickly moving on, I'll spend some time here. So I've talked about stocks, I've talked about bonds. And again, I'm certain that some of us might know what they call mutual funds. So mutual funds, for instance, if you go to Nigeria, there's some banks you go to and they say, I want to invest in a fund. So a mutual fund, you can think of it as or a fund general, not even a mutual fund. A fund, you can think of a fund as a basket. So you go to a store, and you go to a store, I'll try to break it down to make it easy. You go to a store and let's say you want to buy tomato, you want to buy pepper, you want to buy pepper, red pepper, green pepper. So if you want to invest in a stock of one company, that means you go to a store and you pick red pepper, you pick green pepper. So red pepper is Apple, green pepper is Microsoft, for instance. But when you invest in a fund, you're buying a basket. And in that basket, you have tomatoes, which is Coca-Cola. You have Apple, which is red pepper. You have green pepper, which is Microsoft. You have, they call it tatashe. Tatashe is like very hot, pepper. Is it tatashe or rodo? I have forgotten now. Rodo, yeah, Rodo is the very hot pepper. You have different kinds of pepper in the basket. So a fund is a collection of different kind of things inside. Now, what a fund does for you is because remember, I told you that nobody can really time the market. If you have just 1,000 naira to invest and you are not certain about the share of Apple or Microsoft, you are just betting. But you can invest that 1,000 naira in a basket, and that basket will buy you a little percentage of all the different companies you have. So what happens is when something happens to Apple, or if Elon Musk and Trump are fighting and, and the value of Tesla shares gone down, because you invested in a basket that has a share of different things, you are hedging the market. So I always advise, people that, especially that are first-time investors, that if you're convinced about the stock price of a particular company, congratulations, great. But generally, it always makes sense to invest in a fund or to just buy the market. Just buy the market. So when you buy the market, and when I say market, remember I said S&P 500, NGX, whatever. That means the return of the market is going to be your return. So I always advise people to buy funds. So that's what a fund is, a basket. Now, we have many kind of funds. But I'll just talk about, two main ones here. So on the left side, you can see something called an ETF. An ETF means an exchange traded fund. And then on the right-hand side, you can see something called a mutual fund. So keep it simple. An exchange traded fund is managed by algorithms. So that means that you don't have an investment banker like myself sitting at the back end trying to, manipulate the markets and build the markets. While a mutual fund is managed by a real person. So there's someone at the back end looking at the market, trying to build a market. And because there's someone at the back end, you need to pay me. So a mutual fund, the expenses on a mutual fund is a little bit higher than an ETF. Wanted to explain that. Quickly moving on to the next slide because of time. If you look at the left-hand side, so you have a chart that compares, the return on ETFs, globally, using the US as an example, to mutual funds. And what you'll see is that a mutual fund, which your bank probably wants you to invest in, because they're going to charge you fees, has almost a similar return to an ETF. An ETF is like the S&P 500, SPY or VOO. We'll talk about that a little bit later. And the reason is because remember, no one can really beat the market. So what a mutual fund does is invest in the market and tries to do some hedging strategies. But on the right-hand side, using Warren Buffett again, Warren Buffett is telling you that 90% of all his investments are in index funds, which are ETFs. So if Warren Buffett is doing it, why are we not doing it? So if you're listening to me and you're thinking about investing or you have mutual funds, you can leave some of it, but try to do a lot of your investments in ETFs because you can save more. You can save more money because you're paying less fees. And here, if you look at these purple bubbles, you can see the difference in percentage points between ETF and mutual fund. It's the amount that the bank charges you. I work in a bank. I love banks. Well, banks have to make money, but we're here to democratize learning and to set you free. Yep. So that's why ETFs, I would always recommend ETFs for believers. Because of time, I'll skip a lot of the slides, but I'll just quickly talk about just the first paragraph here is telling you that an investment operation is one that promises safety of principal. So you want to be sure that the amount of money you put in, you can get it back and then you can get an adequate return. Remember alpha, you can get an adequate alpha. That's it. Anything that doesn't give you these two things is not investment. I'll skip all these ones because of time and I'll just show you this one. So remember I talked about ETFs. So the best kind of ETFs, there are different kinds of ETFs. So you have ETFs that are stock ETFs, remember the analogy of baskets with Pepe and all those things. They have leveraged ETFs. So those are ETFs that are at the back end where if you invest $1 in something, it will try to get a return of $2 of that thing. If you're interested in foreign exchange, you want to trade Forex, instead of doing all the Forex trading that we used to do all those years, you can invest in, currency ETFs. For instance, if the return on the Naira compared to the dollar is higher, you can invest in that. You can also invest in bond ETFs, and then if you want to invest in oil, there are many ETFs that you can do. And I know the question you ask me is, how can we go about it? Now, I'll get to that, but if you're in Nigeria, for instance, I always recommend having an exposure to the dollar because it's still, the dominant currency in the world. And I know there are lots of startups. I'm not mentioning names. We can do a research because I'm not promoting any one of them. But there are lots of, fintech organizations in Nigeria that will let you invest in US-based startups as well. And in the UK, for instance, I know that because of the European laws and the British laws, you may not be able to invest in US ETFs directly, but you can invest in something called a UCITS, UCITS. So that means it's something like an ETF that will give you the same return like a US-based ETF will be. So just go to your brokerage, or in Nigeria, go to your bank and just talk to them that you want a mutual fund or an ETF, but I'll recommend an ETF. In the US, it definitely is a no-brainer. You should really take advantage of this opportunity. But the goal of this slide is to let you know that an ETF is a collection of different things, and you can invest in a range of different things. Instead of betting on the stock of one company, you can invest in different things. Now, I'll talk about this a little bit. And I'll talk about something called dollar cost averaging, because the question a lot of people always ask me is, okay, I just have 100 Naira, I just have 500 Naira, I just have $50 to invest. I'm waiting to have $1,000. No, remember, time in the market is bigger than time in the market. So you need to start now. So whatever amount you have, no matter how small it is, you need to invest in something. And the principle that we have is dollar cost averaging in finance. So what that means is, let's say you're buying the stock of Tesla at $100. And in January, you have $100 to invest. You buy it at $100, and then you notice that in February you have $100, but the value of Tesla now is 150, but you just have $100. So instead of buying one share of Tesla, you're buying 0.5 share of Tesla. But in March, Tesla has come down. It's now $50. You have $100 to invest. You're buying 2 shares of Tesla. So what we've seen in finance is, if you invest a particular amount consistently, no matter how small it is, you buy high, you buy low. At the end of everything, if you look at a long-term average over 2, 3 years, you're really buying the same amount of the stock or that particular investment. So it makes sense for you to, no matter how small, no matter how high, keep on investing, every time, put it in the market and all those things. So this is what dollar cost averaging is all about. And then the question is also, which ETF should I buy? I can give you specific advice, but generally, what we've seen is it makes sense for you to invest, and I'll pin different scenarios. So let's say you're in your 20s or your 30s, you're all about growth. You really want your percentage, your return to be as high as possible. You want to invest like between 70 to 90% in their growth stocks, so growth ETFs, and then 30 to 10% in value ETFs. So what that means is, you can go to your bank and tell them that, give me a fund that will give me a return of 30%. And another thing you can do is you can use ChatGPT. Just go into ChatGPT. ChatGPT also won't give you investment advice, but you can just say that, please give me the 10 highest value stocks that have the highest return over the past 10 years. So that's something that you can do. Something else I advise people to do is it's always makes sense to have exposure to emerging markets. So if you're in the UK or US and you say that, I've moved to Japan, I'm now abroad, I don't have anything to do with Nigeria, congratulations, but that's not the best thing. That's not the best strategy. So you want to, because there is a limit to the level of growth you can have in developed countries. So it makes sense for you to have some investments, 20, 30%, also in the emerging markets, so Middle East and Africa, China, and all that, India, South Korea. Those, they're not really emerging markets, but we'll classify them in finance, and then 70% of your investments in that. Another thing that people can do is because crypto regulations are now getting more standardized. We can also advise people to invest, 50% in value in growth stocks, 20% in emerging markets. Look for a crypto fund you can invest in. You can do a mix and match, but the goal of this is try to diversify. Don't just invest in one thing. Same as real estate too. If you're investing only in Lagos Island, that's great, but you might also want to look at, mainland. So always have a diversified portfolio, as well. Now on this slide, what you'll see are the top 10 ETFs, in the world. So this number two is interesting because you can see number two is the S&P 500. It was started by State Street and it's called SPY. So that's what everyone has always invested in. Now, you'll see that number two is no longer number one. Number one is Vanguard from Vanguard. And if you look at the expense ratio, so the second to the last column, you can see the expense ratio on SPY is 0.09%. So that means if you invest $100 in this particular fund, if you invest $1,000, you're paying 9 cents, if my mathematics is correct. But with Vanguard, if you invest $100, $1,000, you're paying 3 cents or something like that. So what we've seen is retail investors and institutional investors, they are very, very, very careful. They want to invest in things that will give them a high return with a little expense. So that's why I'm talking about mutual funds, being very careful about mutual funds. So that's why the Vanguard S&P 500 ETF VOO has now overtaken, the SPY in terms of assets. So again, this is what everybody's doing. So you should also think about doing it. So these are the top 10 largest ETFs in the world. If you look at number 5, which is QQQ, so this particular ETF is a basket of all the Tesla, Nvidia, Apple, Meta, and all that. So that's a no-brainer to buy. So when I'm saying that as a new investor, if you want to start, you want to invest 70% in growth ETFs, which is something like a QQQ, and then 30% in something like the market, which has everything. So and if you want to invest in a bond, you'll see number 10 here. But you can always do your research, to get this. Just wanted to point that out. Now, I'll skip all this also because of time. And I would say that if you've not done this before, don't be scared at all. A lot of, bankers, a lot of us are worried about, so I've not done this before, people want to make money off you. I would say if you feel comfortable, you can go to a bank and request for financial advice. If you feel that you can do it yourself, just open a brokerage account. Go to your bank, tell them you want to open a brokerage account and search for, ETFs that you can invest in. Or if you're not feeling comfortable about ETFs at all, you can also open an account with a mutual fund, and just to start with, and as time goes on, you can move on to an ETF. So I'll stop at this for investments, but because we talked about Mansa Musa, I'll quickly just touch a little bit on estate planning. Our moderator was saying something I also praise for with that. Why is it that, Mali is not as rich as it should be, although we had someone like Mansa Musa? And the question and the answer is estate planning. Estate planning is when you've made all this money and you have wealth. The question is, how are you going to secure that wealth to outlive you? And I'm very passionate about this because at least in Nigeria and Africa, we have a lot of people that start, with a lot of money. We have names like the Abiolas of this world and all that. But then after many years, we ask ourselves that why is there no sustainability? And I had a privilege when I went to business school here in the US in Chicago. I had a privilege of going to class with children of billionaires, like billionaires in dollars. And I didn't know one of them, funny enough, we're in a class. And I saw his name. His name is Zabludovic. So for those in the UK, the collection has stopped now. There's a collection called the Zabludovic Art Collection. So I remembered because from my time in the UK that, oh, Zabludovic, coincidentally, your name rhymes to the name of a street in London. And he looked at me and said, oh, that's my mother's art collection. I said, damn. And this guy was very simple, by the way. We just wear t-shirts and jeans and come to class. So I sort of started wearing the t-shirts and jeans, hoping that maybe I'll become rich. But I got close to these guys, and there was another guy who from the Benyami family in Israeli. I also had the son of a president in my class. And I got close to those guys. I became their friends, and I wanted to understand, of course, as much as they could share the structure of their family's finances. And I saw that what I saw that was common to all of them was they had companies. So that's the basic one, which you see number three. In Nigeria, it can be what do you call it? A PLC. In the US, we call it an LLC. I don't know what it's called in the UK. They had companies, then they had a trust, and then they had, a foundation. So what we see is I have a company, I have a company, I have a company. But at the back end, these guys have something called a family trust, and they have a foundation. And I'll quickly explain the structure, and I'll stop, the presentation so we can have time for questions. And but before talking about this, if you look at the slide, these are the 10 largest foundations in the US and arguably in the world. And apart from Bill and Melinda Gates Foundation, which is at the top, if you look at number two, you have something called the Duke Endowment Fund. And if I ask a question, you can guess, like which year was this endowment started? This Duke Endowment Fund. If anybody can put it in the chat, if you can guess. So an endowment is like a foundation that's set up by a wealthy person to manage resources. Anybody can just hazard a guess. The Duke Endowment Fund. You can just put a random year. Is it 1960, 1970? You know, the Duke Endowment Fund. When do you think it started? Anybody? Okay, I can see responses. 1992, 1950. Yep, you're close. The Duke Endowment Fund, and thank you for your responses. The Duke Endowment Fund started in 1924. So there was a wealthy man called Duke, in the US and started a foundation. And that endowment today is still the second largest in the world. Then the Ford Foundation, remember the Ford that we all drive? It became very wealthy from standardizing, the assembly line in cars. And when do you think the Ford Foundation started? 1936. And it's still here till today. And a lot of us that have companies are still applying to the Ford Foundation for grants because someone had a vision in 1936. Moving on, J. Paul Getty, 1953, and all that. Anyway, because of time. So the point I'm trying to make is I've not heard of any African foundation, African trust. So what Mansa Musa could have done was to have set up a sort of a foundation or a trust that will hold all his assets. And this is a mistake that we all make as Africans, where it's all about the amount of money we earn now, but we're not thinking about generations. So remember, having a company is basic, that's just the minimal one. Setting up a trust to hold assets in the company, then setting up a foundation. And quickly, how do they do this? How do they do this? I know this chart looks complex and we don't have time to talk about it, but if you look at the bottom of this particular chart, they have a family foundation that holds the assets. Now, these assets are held in a trust, you know, they hold the assets in a trust. So, and those assets include companies. So they owe their companies in a trust, and that trust is owned by a family foundation. So the foundation is governed as an NGO, and then the trust is just a legal entity that holds all the companies. And why is this done? The goal of rich people, and I want us to again change our mindset, is it's not about having your name on everything, it's about you controlling everything. So what those billionaires do is they own nothing in their name, zero, but they control everything. And what is a trust? So a trust is a legal agreement that will allow you to transfer your assets across different generations. So you can go to a particular lawyer, set up a trust that everything I own is now owned by this trust, so that in case anything happens to you, and you can set down rules that nobody in my family can take more than 10% of this amount every year. Nobody can do this, nobody can do that. And what that happens is you can save and you can keep your money in the family. And a trust is also a little bit superior to a will because what we've seen is when people pass on, now they have a will, but a will is a public document anywhere in the world. But with a trust, you keep that information, out of the public domain. That's number one. And number two, you don't have, in the US, we have something called probate. I think it's also similar everywhere in the world, where when rich people pass on, you have to file the will in the court and all that. A trust, you don't have to do nothing. In a trust, already you've outlined who gets what, and you institutionalize your wealth. So I think I'll stop here because of time. And I'll just say, let's start thinking not just about the investments that we can make now, but how we can institutionalize, those investments by creating the structures in place. And that answers the Mansa Musa question. If Mansa Musa had done that with 400 billions of dollars to set up a trust for the company or set up a fund for the country, Mali will probably be the richest one. Think about Norway as I'm ending. Norway has something called a sovereign wealth fund. When I lived in Europe, have you noticed that even for those in the UK, for those in the US, you don't see Norwegians come to the UK that I'm a Japa or you come to the US? No, because anybody that is born with a Norwegian passport, by virtue of that Norwegian passport you carry, you're already worth $600,000 or something by birth. So what Norway did was when they started earning money, they set up a trust fund for the country, investing in all these things I showed you here, all those SPY, VOO, QQQ, all those wealth funds have a share in it. Uber, all the startups, they have a wealth fund in it. They invested it. And every second, if you just Google Norway sovereign wealth fund reports, you will see how much the money is increasing. So that's what Mansa Musa could have done. If Mansa Musa couldn't do it, I believe God has brought you here for a reason. You need to start thinking about that. How can I set this up for my family? And I pray that God will help us in Jesus' name. I'll stop now and yeah, I'll pose some questions. Thank you.
Thank you very much, Paul. It's like I'm in an MBA class, kind of. That was master class. Thank you very much for sharing your gift with us. I am sure that the people are excited. Some of our people are in. I've not seen them in a while. Okay. Whenever we talk finance like this, everybody just shows up because people like money. Okay, guys, so if you have any question for Paul, please kindly, you might want to put it on the chat box or you can raise your hand. And if I'm excited, I'll call you. All right. Because we want to make it very snappy. Now, Paul, you touched on something that is very important, and I hope our people did not they took note of that. The issue of Ponzi scheme, which I don't know, seems to, I used to think that Ponzi scheme only sold in Nigeria, right? But I've now learned that it even sells a lot to our people, even in North America. Um, I didn't know how many people were involved. I mean, the last Ponzi scheme that collapsed, which is some scooter business. I mean, I'm a very analytical person. When something doesn't make any sense to my brain, I avoid it. So how do you buy scooter somewhere and then people are renting and they're going to be paying you money? How many people use scooter in the world that will be sustainable? But looks like our people just love the person who deceives. Maybe because also, I think there's something about our psychology where we don't value process. We don't value long-term planning. So if you say now that, guys, let's come together and build wealth every month, put money aside for the next 10 years, even if it's $200, right? Our people are not interested. But if you say, I have found something, it's you road tire, the road tire in Africa, you invest like this, why do you think that is so? Why, what do you think is responsible for our inability to build gradually and build for the long term as against miraculous? People love miracle, instant success. Why?
Yeah, yeah, yeah. No, thanks. That's a very very good question, and the simple answer is our culture and our mindset. And when I'm saying culture, I'm talking about like Yoruba, Igbo, and all that. I'm thinking about our culture as a people. Now, the Bible says that whatsoever things are right, whatsoever things are excellent, whatsoever things are pure, lovable, admirable, noble, true, think on these things. So. If you want to change your mindset, and we can use an analogy of someone that uses a restroom, for instance, if you want to flush whatever is in the restroom, you have to pour in clean water. You have to keep on pouring in clean water until it gets clean. Now, the same thing with us is, our mindset and our belief structure is I can do this thing as fast as possible. I can do this thing as fast as possible. Someone told me this, someone told me that. We don't really research, we don't really read. And there's this principle in psychology, it's called the Dunn and Facet principle that a lot of people that are not wealthy, a lot of people that are poor, let me use the word, underestimate the knowledge that wealthy people have. I'll say that again. A lot of people that are poor underestimates the amount of knowledge the wealthy people have. So we need to learn. You need to understand the way money works. It's not just about listening to pastor telling you that, oh, say amen 20 times. I mean, my parents are pastors too, so I'm a preacher's kid. But there's a place of you doing the work. There's a place of you doing the work. And part of doing the work is number one, changing your mindset, learning, understanding how money works. So I had a passion that I want to understand how global finance works. And I started meeting people. I got people to mentor me, and I think a lot of us are not lazy in that regard. We want to do things, we want to get rich fast, but it doesn't work that way. So the first thing is the mindset. You have to change that. Then number two, look for mentors, look for people that people that are successful in that particular thing and sit down with them. Sit down with them, understand the way money works, and they'll tell you that, hey, yeah, it doesn't work this way. And Ponzi schemes, by the way, Ponzi is a Russian name. It's started from Russia. Started from Russia, and now it's in Nigeria. So we have to be careful. So the mindset, taking time to learn, taking time to understand, and yeah, working on a mindset.
Okay, thank you very much. I can see Lois, I can see Olabi. Olabi, can you unmute yourself and ask your question? And then I'll take Lois. Yeah.
Thank you so much, Paul. I enjoy every bit of it. Thank you, and thank you so much for praise. For bringing quality people to this platform every time. My question is around 401k. Okay, so I've heard people talk about because of the fact that they're going to tax you heavily at the end of the year. They do not encourage people, investing into 401k. What would be your guidance on that?
Okay, a very good question. So with 401k, I would say that, and 401k for those who are not in the US listening to me is just a pension scheme set up by the government, and it's called 401k, 401 after regulation. Now, the 401k in the US, so the advantage of it is employers do something called matching. So if you invest 10% of your salary in your 401k, employers will match up onto 6%. Now that matching is free money, so you want to take advantage of that free money. So what I would say is if a company will match up to 6%, try to do up to 6% to get a full matching. Now, because of the tax implication, I know that when you're setting up your 401k, you can either set up a Roth 401k or a regular 401k. So a Roth 401k means you've paid a tax already, so that when you retire, when you get the money, you are not going to pay taxes on it. Now, not all companies offer a Roth 401k. If it's just a regular 401k that your company offers, I would encourage you to take advantage of it because of the matching. And what you can now do is to set up something called a Roth IRA. So it's like a pension scheme that you own personally and you've already paid taxes on it, so that when you withdraw the money, this one is not managed by your company at all. So when you withdraw the money, it is tax free. So I would encourage you to have both the 401k in your company, keep it because of the matching, and then open a Roth IRA on your own personal. And if you leave your company, by the way, remember to take your 401k, then roll it over into the Roth IRA. So yeah, I can also take that offline.
Okay, Lois, are you still on the call? Okay, Lois has asked a question. How do I raise huge money legitimately as a salary earner having no business? So that's Lois, but there's a similar question. What is the practical way to get started if I live in Nigeria?
Okay, yeah, very good question. So I'll start with the first one about raising money legitimately as a salary earner. I know as a salary earner, your income is maybe limited or capped. So what I would encourage you to do is two things. Number one, in terms of a profession, is there a way for you to pivot into a more strategic role, not necessarily in your company, in something else? I'll give you an example, artificial intelligence. So I started my career as an engineer, and then I moved into core finance. And then right now, working on the bank, I see that everything's about data and AI. And I remember that, hey, I have 2 degrees in engineering. So I started looking for roles in data that I could leverage my engineering degree because it pays more. And I was able to pivot into that role. So that's something that you can do. Now, the other thing you can do if that's not easy is to look for something on the side. Also, what are you good at? And a lot of people have asked a question, and you can talk to people like Chris Way in terms of what are you good at? Is there anything that you can sell? For me, I noticed that I love talking. God has given me the gift of teaching people things. So I opened a consulting company on my end, and it's crazy how much they pay me per hour to talk. but it didn't start immediately. It took a lot of in-depth analysis on what my gifts are. So if you can increase your money as a salary earner, you might start thinking about what are you good at, what can you sell. Yeah, I know it's not a very easy answer, but those are the two frameworks I'll give now. The other question about how can I get started in Nigeria? So it depends on what you want to get started in. So if you're thinking about getting started with capital markets, I would encourage you to go to banks. I know there are all those Stanbic IBTC, GTB, and all that. Go to them, have a sit down with them that, oh, I want to open a brokerage account. I want to invest in a mutual fund, which if that's the only thing they offer, great, but preferably an ETF. I think Stanbic IBTC has something like Stanbic IBTC 30 ETF or something, and then watch the performance every month. And as time goes on, you can diversify. So how can you get started? Depends on what you want to get started in, but I would assume you're talking about getting started in investments. Then just go to your bank, open a brokerage account, and start next month. Start today, with as little, and then it compounds, yeah, over time.
Yeah, someone else. Okay, Toro wants to ask a question, but someone asked a question and they said, what do you see as the single biggest underappreciated risk to mutual funds and ETFs market right now? That's a question from the chat box, and I'll take it to Itoro.
Yes. So the underappreciated risk is I'll call it the uncertainty gap, which is the fact that right now, based on projections in finance, it looks like we're heading towards a bubble. So what a bubble means is that the current valuations of stock prices cannot really be sustained by fundamentals, especially by artificial intelligence. So what a lot of hedge funds are doing, and this is in the public domain, I can share it, is they are either trading options or they're diversifying. So if you have a lot of exposure in the market right now to artificial intelligence stocks, all those fancy companies, you might want to start buying either emerging markets, ETFs or funds, or stocks, as it were, or you can also start buying bonds. Now, when you start buying bonds or value stocks, keep in mind that the return will probably be like 5%. It won't be high. But if in 2 years we are not at a bubble, then you can sell and move on to back to what you were doing. So that's what I would say is the largest risk and ultimate to get it.
Okay, Itoro.
Hi, thank you so much. Please, I have two questions. One is, do ETF funds give dividends or capital gains or both? And then the second question, should incorporations invest in the market as a source of emergency fund strategy?
Oh, a very, very, very good question. So the ETFs gives dividends or capital gains or both. I'll say it's both. So it depends on which kind of ETFs you invest in. So for instance, let me give you an example. There's an ETF called the SCHD, which is the Charles Schwab Dividend Equity ETF. Capital gains is not amazing, but every month it will give you income. Now, if you also invest in the likes of VOO, for instance, it's a capital gains ETF, but it's just to pay dividends. So any ETF you invest in, I think just doing the research, checking if they pay dividends, you're using ChatGPT or Google will show you what's both. So you can either invest in pure dividend ETFs or pure capital gains ETFs. Now, can a corporation invest in ETFs as an emergent strategy? I would say yes and no. So I personally have two companies that I run, and I have brokerage accounts in the names of those LLCs. So any free cash I get from my consultant, I just buy specific ETFs and I leave that in the market. Now, if if you have a corporation and you know that your working capital needs are very tight, so that means that you need money to pay your bills, to buy raw materials and stuff. I wouldn't advise that you should use the money in ETFs. You can leave it in the money market, as the money markets are like overnight triple trades and all that. But then if you have excess savings, then yes, definitely go for it. So it depends on what your cash flow is like and what your working capital needs are. Yeah.
Okay, thanks for this teaching. I know you didn't talk about real estate, but what do you advise on mortgage repayment, especially if I'm looking at paying off early?
Yes. So if you're looking at paying off early, I would say it depends on your personal situation, also the interest rate of the mortgage. For instance, I own some properties in Europe. By God's grace, the interest rate is 2%. I can't get that interest rate again, right now. So I would never, I'm not never, but right now is my priority to pay off that particular mortgage is low. Now in the US, the properties I own in the US, interest rate is 7%. So if I can find a way to pay down that particular mortgage, I would the principal, I would rather do that to reduce interest rate payments. So I would say that depending on what the interest rate is, if the interest rate is low, you can leave that and invest in something that will give you a higher interest rate on the market. If the interest rate is super high, you might look at ways of refinancing or paying off. But generally, I would say if you have the potential to invest in a fund that will give you 20%, and you want to pay off a mortgage that has an interest rate of 5% with that cash. That means you're leaving 15% on the table. You know what I mean? So that's why you have to do your analysis a little bit. But I would say mixed strategy is good. Don't put all your money into repayments. You can put some in the fund and then use some to repay.
So we have two questions. Um, a rejoin, when you are evaluating a potential deal or investment, what are the top three non-negotiable green flags to look out for? And then someone is asking, what's your take on equity release options for mortgage financing?
Okay. Okay, so the first one about what are the top three, negotiables? I would say that number one, if you're investing in, so it depends on what you're investing in. So if you're investing in a business, for instance, like we invest in startups, so I'm an angel investor. So look at, the founder. Do they know what they're talking about? So we have lots of young boys now that speak really well and the bamboozle with grammar and all those things. They take your money to run away. You want to be very careful that person has a track record in that area or has somebody that has a track record. So that founder market fit is super important. Number two, awareness of the competition. You don't want someone to come to you with a business idea and the person will say that there is no competition in the space. We are the best, we are the greatest. That's not true. There's always a kind of competition or someone that has a potential competition. So I watch out for that. And then number three is what's the potential return on investment? How fast can I get my money back? So that's if you invest in a business. If you're investing in a fund as a way, you want to look at the interest rate, you want to look at the rate of performance of the particular fund over so many years and yeah, that's what I would say. Now, the second question, which was about equity related release option for mortgage refinance, for mortgage financing. So I would assume that you have a basket of investments. Oh no, equity in terms of the house itself. Okay. So in terms of the house, if you've built up equity, so let's say you live in somewhere in North Dallas where rich people live, like Pastor Chris where in North Dallas, and you bought the house $500,000, and right now the house is worth $1 million, and your mortgage is just $300,000. So that means your equity is $700,000. You have that equity sitting on it. So I would say if you're refinancing that house from a very high interest rate to a low interest rate, yes, you can consider the equity release. But if the interest rate is already makes sense, you might want to use the equity to buy more assets. So you might want to get I've forgotten the name now, and what's the name? And HELOC. Yeah, so you might want to get an HELOC. It's for those in the US where you can use it as down payment, for something else. So that's what I would. But tapping into your house equity, by the way, plan that should be your last option. So I know a lot of people that tap into their house equity all the time. No, that should be your last default option. So yes, so it depends on the interest rate again. Yeah.
Okay, our time is fast spent, so I'm just going to ask one more question. A lot of people, I mean, people have asked this question in bits in my private chat. What is your take about cryptocurrency? Some people have appetite towards it, maybe because of the back end, what's backing it. People have lost money because people come up with different projects, different coin, and then they open a Telegram group, people put money, and then you wake up one day and realize that the founder, the owner of the whatever has jackpot, all right? And so that's on one side. The other side will be startups, and I want you to touch a bit on that. You mentioned it in passing. How do you deal with sweet talking CEOs who have no founders who have no track record, no corporate governance, because it's scary the rate at which a lot of startups are collapsing. It's almost like there is an unspoken truth there that people actually do startups not to scale or to go to build to last, that they just do it like a Ponzi scheme and they have an exit plan after which they liquidate the company. Can you speak a bit to both crypto and the startup investment? Yeah, those would be
Yes.
the
So in terms of crypto, yes, I would say that be very careful with crypto, but it makes sense. In fact, I would advise to have exposure to it. And I'll give you an example. So I got into Bitcoin when I was like 10 years ago, but again, it wasn't doing well. So I wanted to go to business school and then money, I sold it. And then Bitcoin is now like over 100 again. I'm always thinking that, oh, damn, I should have held on to it, you know? So, but there are two pieces of legislation that have been passed in the US. One is called or that's still been discussed. One is called the Genius Act, and one is called the Clarity Act. Now, the Genius Act related in relation to crypto is setting up a framework of how crypto will be governed, and then the Clarity Act is going to set up a regulation on how stable coins will be. And BlackRock, which is the largest asset manager in the world, like all these multinationals you see in the world, BlackRock owns a share in it. So BlackRock has set up an investment fund targeted at crypto. And banks are now looking for ways to get into crypto. So what I would say the best way to get into crypto is, those meme coins, Dogecoin, whatever. I'm not a fan of those, but I would say you can buy a crypto fund. There is the largest crypto fund now is called IBIT, IBIT. You can search for it. So for those in the UK, you can easily just keep on buying the crypto fund. So that way you have exposure to what's happening in the crypto market without committing more to it. But don't go and buy one random coin by one guy with earring and dreads in front of a computer. You might be wasting your money, but have exposure to it, because the world is moving there. That's what I would say. Now, in terms of startups and yeah, Chris always knows this a whole lot. I'm part of the advisory council of a startup called Midlothian Angel Network in Dallas, and our experience has been very interesting. So initially when we started, we invested in a couple of startups in Nigeria where you invest and then the founder runs away and all that. So we stopped investing in operations in Nigeria. We started looking at uh, people that have Nigerian heritage or that Black people heritage that have operations in the US because of corporate governance. So a couple of things to look out if you are looking at investing in startups is number one, your money is hard-earned. You work very hard for your money. So you have to be very careful that we invest only startups that already have revenue. So we don't finance business ideas. Talk to your daddy, talk to your mommy, go to your cousin, talk to them in church, but there should be revenue already. So if there's already revenue, then we now look at the fundamentals. So what's the expected income? What's the expected income of the investment? What exactly is the business of the startup? And then number three, we look at the team and the founders. Is it a one-time thing? Do they already have partnerships? And what makes it even easier for us, which we're doing right now, is we are co-investing with big people, with big guys. So if like Inya Boyeji, I'm sure a lot of people know Inya Boyeji has invested in something and other guys were invested in it. So it makes it more interesting for us because we do our due diligence. So startups are very risky. I would say that should be the last thing to consider when you're starting your finance journey. Do more of your budgeting, your saving, your debt payment, investing in funds. And if God has blessed you and have extra money, invest in startups. But know that you can lose all your money in capital letters. You can lose all your money. But if you do your due diligence well, you can get unbelievable returns. So that's what I would say in that sense.
Thank you very much, Paul. It's been a pleasure having you. God bless you.
Thank you.
We hope to call you back and come and share from your world of experience. I know how expensive it can be to get you, but thank you for doing this for us, for doing this for our community. Amari bow. That's the way you
I should
bow.
know, sir.
Thank you very much. Okay, guys, before I hand you over to Lena, that's you hearing from Paul. And the best thing you can do is to run with some of the things he's shared. Well, I don't know if some of you are aware that the House of Saviors has a cooperative, right? It's called the Passioners Cooperative. So you might want to go join that cooperative. I think they have two deals, share capital, that they are working on right now, two groups, a group that can, I mean, it's very, very low basic. If you want to do a million a year, a million naira a year in Nigeria, or you want to, the second group of people want to do a million per quarter, which means like 4 million a year, kind of. And then they are putting the funds together and they are investing. But you've got to be patient because for the next 5 years, they're going to help you grow your funds. So you want to join that at the basic level. If you're looking for where to start, I'm sure that Lena will share how you can join the cooperative. And so I want to appreciate all of you, Ocean, and please don't be in a hurry to go. If you have stayed this long, Some of you just attend and you run away. Always ask, what can I do? How can I support? And thank you, Wale Salami, our guy at the top. Looks like you are now the Ballet of Dallas because our ballet has disappeared. He has jacked back to Nigeria. We can't find Mete again. So I think we need to do another coronation so that that position is not vacant. Okay, so Lena, over to you. Thank you very much for having us.
Thank you. Thank you so much. Thank you, Mr. Paul. I'm sorry I can't yet pronounce your last name, but thank you so much. And once again, thank you to PF for bringing such amazing people with such depth, wealth of knowledge that we can tap from your network. And they say your network is your net worth. So thank you for extending your network to all of us here at the House of Saviors. May the Lord richly bless you. And I'll just mention 3 things that I took from I'll call it a masterclass because it was. So the first one is institutionalize your wealth. Because if you want it to outlive you, you have to institutionalize it. And then the other thing is, before you invest in anything, please do your thorough research. Do not invest in things that you do not understand, and do not be anxious for a quick return on that investment. The last thing I'll say is, though he didn't explicitly say it, is do not risk more than you are willing to lose, especially if you are investing in, the markets fluctuate and you may lose your investment. So do not risk more than you are willing to lose. So thank you to everybody. Thank you for joining us. And I'll quickly share the announcements. Please stay tuned to the very end of this session. You will still be blessed. And like Mr. Praise mentioned regarding the cooperatives, the details will soon be coming up. Just give me a moment as I share my screen. And please confirm you can see my screen. All right. Okay, so thank you. Thank you so much for joining our General Assembly meeting today. If this place looks like where you want to hang out every week, please feel free to do so. Also invite your favorite people who have the Savior's DNA so they can be a part of this amazing assembly. Aside attending our General Assembly meetings like this, you can become a member of the House of Saviors by subscribing on the link that is showing, or you can scan the QR code that is showing on the screen, as this allows you to register officially and join the region or department in which you can save. I'll ask admin to please post the link as well. Yeah, please post the link in the chat box so people can get onto it. Your premium membership yearly subscription can be made via the House of Saviors premium member, the link that is showing there. It's 50,000 Naira for an individual or 80,000 Naira for a couple. This membership offers value add that includes sessions where we discuss replicable and scalable success templates, accountability, access to the team of 10, being part of a clan, cooperative society, and more. Please scan the QR code again, or admin will post the link in the chat box. To join the Passioneers Cooperative Society, the application process is open to House of Saviors premium or subscribed members only. And also we are requesting for volunteers. So we need volunteers as moderators and social media managers. So a moderator is basically doing what I'm doing at the moment. Please reach out to Ayo on the number that's showing on the screen. Our admin, again, is going to post this number on this in the chat box if you would love to serve. We look forward to having you as part of our team. Our meetings are sustained by voluntary donations. So we appreciate your support, and you can give through Praise for War International Zenith Bank PLC. The account number is 101-492-7099. This will also be posted in the chat box. Our meetings are about impact, and so we expect you to go out there and practice what you learn here and come back to share your results. Always remember, We are on a journey of raising saviors for our world. For further inquiries, kindly contact Ayo on +234 818 466 8090. Again, the number will be posted in the chat box. So at this point, I'll ask every one of us to unmute. Admin, if you could please allow all our participants to unmute so we can read out the creed together. And as you read the creed, please let the words speak to you, because